Today's webinar here at Stratton Markets, I want to introduce myself. I am the new market analyst here at Stratton. My name is Mihaly Zefthimiou. That may be quite hard for some of you to understand. For you that may find it a little bit hard to pronounce, you're more than welcome to call me Michael, which is Mihaly's translated in English. So today's webinar will be based around how to use technical analysis in your day-to-day trading. Now, I'm going to try my very best to keep today's webinar as basic as possible, because I'm sure we're going to have some new traders which have very recently joined Stratton looking at this webinar. Now, anybody who wants me or one of the account managers to take what I'm speaking about today in a little bit more detail is more than welcome to get in touch with us. I will put our contact details at the end of the webinar, and I'll be more than happy to get one of the account managers or myself to go in as much detail with regards to technical analysis as you wish. But for today's webinar, I'll try my very best to keep it as basic as possible. And at the end of the webinar, anybody is more than welcome to send through to us any kind of questions with regards to either their experience with regards to something that I'm speaking about today, and so on and so forth. Now, just a bit of an introduction to myself. My name is Mihaly Zefthimiou, Michael. I'm the market analyst here at Stratton. I'm quite new here, although not new at all to the industry. Just to give you a little bit of an understanding about myself and my experience, I started off as a financial advisor approximately 7 years ago now in London. I was based around investments and mortgages, secured loans, underwriting, etc. I don't want to bore you. I won't go into too much detail. I've been trading for about 7 years approximately. I've traded different types of securities in the market. I've also have a CMAP license and a SISIC advanced certificate holder as well, which gives me the license as a financial advisor. Even though in today's webinar, I will not be giving any financial advice. I want to try and give you as much information as possible to get you on the right path in your investment. The idea and the reason we've designed these webinars is so that by the end of the webinars that we have designed for you, you come out a trader who can trade responsibly and comfortably. Now, if you're new to Stratton, I want to tell you a little bit about Stratton. The most important thing here at Stratton that we want to let everybody know is that we are fully regulated by SISIC. So SISIC, for anybody who does not know, is a European regulator. We are fully regulated by SISIC, and we follow European laws under SISIC. Our head office is in Cyprus, which is in Eastern Europe. Very sunny, beautiful beaches. Anybody who's looking for a holiday destination, this is the place to be. We have our very own online trading platform, as well as the MT4. Anybody who has a little bit of experience will know what the MT4 is. Anybody who doesn't, I will go in a little bit more detail with regards to the difference as time progresses. Now, we have structured a variety of different webinars for you that will cover everything that you could possibly need to know with regards to analysis, with regards to trading, and so on and so forth. We have structured them and arranged them every Tuesday at this time. And Each time we will have a session at the end where you'll be able to ask any questions, and either myself or an account manager will come back to you with the answer. Now, as you know, trading CFDs is an investment. Each investment has a risk, okay? Now, I want everybody who's trading with Stratton to be aware of the risk involved in their investment. So anybody who doesn't, please speak to the account manager. Please do your own research and speak to myself if you wish. And we will make sure that you're fully aware of everything that you need to know with regards to this investment. Now, just to tell you a little bit about today's schedule and today's webinar, okay? Now, I've done a lot of research with all the traders here. A lot of people are watching a lot of videos on YouTube with regards to how to trade securities and different strategies. I'll go in a bit more detail as the webinar goes on why you should not be doing that. I will also be speaking about support and resistance, which is such a massive part of technical analysis, probably the biggest part of technical analysis. I will be explaining why that is. RSIs, moving averages, how to implement these into your trading, retracements in the markets, different strategies, trading the range and false indications. Now, for new traders, some of these aspects of trading, some of these subjects that I've said, you might not know what I'm talking about, possibly. Do not worry, this is the point of today's webinar. So everything that I'm mentioning here, I will go into detail, and by the end of the webinar, you'll fully understand what I mean by these terminologies. Now, starting point. We're here to learn about technical analysis and how to use it in your day-to-day trading, no matter what kind of trader that you are. Now, what is technical analysis? Some of you may know. Technical analysis is traders analyzing price movements of the charts. The philosophy behind technical analysis is that a trader can look at historical price movements and determine the current trading conditions and future price movements. Some of you may know what that means, some of you may not. This is the standard definition. In basic terms, what does technical analysis mean? Now, technical analysis basically means looking at the chart, okay? And being able to analyze exactly what is happening in the market to be able to try and identify a pattern in the market. This is what technical analysis is. Looking at the pattern in order to try and determine what is going to happen next in the market. How is the market going to move next? Okay. Now, some of you might not have heard of technical analysis, but I guarantee you most of you would have heard technical analysis strategies such as buying the dip. Okay, everybody, whether you've never traded before, whether you have been trading a very long time, will know of certain strategies. Okay, now I'm going to go into a bit more depth how these strategies work, whether you should be using them, if you are going to use them, what risks are involved, and what you need to look out for. Now, look at this graph, okay? Now, this graph here, okay, is a line chart, okay? I've chosen a line chart because it's a little bit more easier to read, okay? Now, currencies, okay, and stocks and commodities, indices, whatever it is that you could possibly be trading, will have a graph that looks similar to this. Okay, now what we said technical analysis is looking at a chart exactly like this chart and trying to understand its movements and its pattern. Okay, so I want everybody to be looking at this chart. okay, and trying to spot a pattern. Can anybody here spot a pattern when looking at this chart? Now, what I've done is I put 2 lines here, okay, to try and assist you with regards to the technical analysis side of it, okay? But everybody here, when looking at this graph, should be able to pinpoint some kind of pattern. Everybody can see that when looking at this graph, that it is going down, the charts and the price is going down. It goes up, it goes down, it goes up, it goes down. What we call this in the market is volatility. It is moving. It is not a straight line like the red lines. This is what bank accounts normally look like, interest on bank accounts, okay? It's not like that in CFD trading. It is a high volatility market, okay? Now, technical analysis. Everyone can see that it goes down. When it hits the bottom line, it is going up, and so on and so forth. Now, what does everybody think is going to happen here? Okay, I hope everybody is saying that it's going to go down and that it's not going to go up. Now, the reason I say to people not to look at your YouTube strategies is because most of them are YouTube enthusiasts trying to get rich fast, and they're normally using a chart which is non-existent. It's a chart that is in a once-in-a-lifetime chart, which is extremely hard to find and very rarely you will come across. Now, you will notice here that I'm using a very up-to-date chart. It's from this month, okay? And it is a security which anybody can trade. It is the British pound against the Canadian dollars on a 30-minute chart, and it is from this month. So, technical analysis, what a trader should be looking at is the pattern. We can see here a very, very clear pattern. Judging by this pattern will be indicating to you whether you should be buying for it to go up or selling for it to go down. Each time that it is moving with your investment, you are making a profit. Each time it is moving against your investment, you are making a loss. Now, this is the very basics of it, okay? Let's go in a little bit more detail. Okay, now, YouTube videos. I want to explain why not to watch YouTube videos. I've spoken to many account managers, and a lot of problems that traders are finding is they're watching YouTube videos and basing their strategies on the videos, and they do not work. Why do these strategies tend not to work? They tend not to work because they're using a chart that does not exist. It may have existed at some point. It is not an up-to-date chart, and they tend not to look at the risk side of the strategy, okay? So I've done a lot of research. I've looked at different types of strategies that people are watching on YouTube. Most of them will probably have a very low success rate. So I want to make sure that anybody who is watching any kind of strategy on YouTube is not basing their strategy solely on this. Okay, support and resistance. Support and resistance points, okay, is one of the biggest parts of technical analysis. Okay, so the theory surrounding support and resistance are undoubtedly two of the most highly discussed characteristics in technical analysis. As I've just said, it is one of the biggest parts of technical analysis. Any kind of strategy or indicator that you're using will have some kind of aspect of support or resistance or oversold, overbought points. Now, these terms are used by traders to refer to levels on the chart that tend to act as barriers, preventing the price of an asset from getting pushed in a certain direction. Okay, now what do I mean by that? As we saw in the previous chart, that at certain points, the price was coming down. It was finding what we call resistance, a resistance point, like the red line in the previous chart. When the price was hitting that point, it was finding a resistance and moving further down. Now, the support level is the lowest level which the security tends to trade at. So the opposite of the resistance. So we have the support and we have the resistance. And the price tends to trade in between those points for specific period of time. It might be for long periods, it might be for short periods, it could be something in between. This is what the support and resistance is. It is the point which the currency price, or if it's a stock, the stock price, if it's a commodity, the price of the commodity, is struggling to pass. It is not necessarily the word of God, and it never passes, but it's the point where the security tends to struggle to pass. Now, this is a big part of technical analysis. And let's look at a way in which a trader, especially a new trader or even an experienced trader, can use indicators, which is a tool, to be able to pinpoint the support and resistance points. Okay. Now, as a new trader, it can be quite hard to be able to pinpoint which parts of the chart a security is going to find difficult to cross. Now, what I'm going to show and try and inform everybody is a point, an indicator, which can help you to pinpoint those support lines and those resistance lines. Relative strength index, okay? Sometimes this is referred to in the trading markets as an RSI. It is the exact same thing. So if you hear an RSI, you know it is the same as a relative strength index. This index can be placed on the online platform, or if you're trading on the MT4, it can be placed on the MT4 as well. It is what is known as a momentum indicator, which helps you to determine which point in the market the security is either too high or too low, okay? Or in some cases that it's decreased too fast or decreased too fast, okay? Now, this can help you to pinpoint support and resistance. It can help you to pinpoint on the chart which points and time and price the either currency or stock or whatever you're trading is likely to find support or likely to find resistance. There is things that a lot of people aren't aware of that you can use to assist you with your trading. An RSI, a relative strength index, is one of them. Now, what I have done is I've put in an example here. Now, the tool, okay, the RSI is this at the very bottom, okay? This is an RSI, okay? It pops up at the bottom of the chart, okay? It's normally got a blue line and two dotted lines at the top. Now, at the end of the webinar, I will show you how to put it on your MT4, okay? So let's not worry about that for the moment. Now, you can see here, okay, on the chart, each time the RSI, the blue line, okay, is hitting the dotted line at the bottom, okay, it is finding support. Each time it is getting close or hitting the top line, it is finding resistance, okay? It's quite easy to understand. Try not to overcomplicate it. It is quite simple, okay? Top line, top dotted line, resistance. Bottom dotted line, support, okay? Now, what do we notice? When it is hitting the bottom line, okay, the price is moving up. When it is getting close or even hitting the top line, as we see here, it is finding resistance. So each time it hits the bottom, it is moving up. When it gets to the top, it moves down, as we see here. and then when it's getting close to the bottom again, it moves up, it moves up. When it's getting close to the top, we should start to look at it finding resistance. Now, as I said to you before, indicators is not the word of God. It is not 100%. You shouldn't be basing your strategy solely on one indicator or two or five, okay? The indicators that are there solely to assist you. It is just one part of technical analysis. It is just one part as your whole analysis as a whole. You also need to look at other aspects in the market, but we're going to cover these one by one. But we can very clearly see how an RSI can help you in your day-to-day trading. So it is giving you an indication on how the market is going to move next. As you can see, sometimes it moves bigger than others. There's bigger movements, there's smaller movements, okay? But we can clearly see here that it is quite accurate from this chart here, but doesn't necessarily mean that it is always accurate. This is why it's important to have a risk management plan, to have a trading plan, and to have an overall effective strategy. Now, across the next webinars, we're going to cover all of this. So the idea is at the end of the series of webinars, you will be able to design yourself a strategy, a trading plan, and a risk management plan so that you are trading and hopefully seeing the results you're looking to get. Right, earning from the retracement in the trend, okay? Now, what I want to point out here is that there's very clearly two trends here, okay? So if I take my pen, we can clearly see that there is a trend going down, okay? And there is very, very clearly a trend going up, okay? There is two trends, okay? Something you need to know, okay? And I'm sure some of the more professional traders and experienced traders will already know, but especially for the beginners, is that no trend will look like a straight line as my red lines on the screen do. They will not. There is something in the market called a retracement, okay? Now, retracement, okay, is when the trend has a pullback, okay? There is a very temporary, sometimes longer, sometimes shorter, sometimes bigger interruption in the trend. Okay, so if we look at the downward trend here, okay, we can see it's not a straight line. There is an interruption here. So it changes direction. It changes direction again. Here it changes direction again. Okay, this is a retracement. We're looking at a downward trend, but on 3 occasions, maybe 4, okay, we have seen an interruption trend. This is an upward trend, okay? Again, we're seeing an interruption in the trend, pullbacks or retracements, okay? Here's a retracement here, there's a retracement there, and then we've got some smaller ones here, okay? Retracements are good in the market. There is 2 types of traders normally. There's traders that are trying to earn a profit from the trend, and there's traders trying to earn a profit from the retracement in the market. Okay, so you've got 2 options. Let me get my eraser and make this screen a little bit pretty for you. Okay, you've got an option of either placing a trade here and earning from the whole trend. Okay, placing a trade here and again earning from the trend. This is trading the trend. Okay, there is, however, traders will find it easier, okay, so instead of trading the trend, to trade the retracement. So they enter here and exit here. They enter here and exit here. They enter here and again exit here. So they're smaller trades, much smaller trades. But instead of opening one long-term trade, they're opening 3 or 4 shorter-term trades. Now the outcome at the end should be very similar. But there is 2 options here. Now, the RSI, which we can see at the bottom, and hopefully everybody spotted it, is a great way to be able to determine when there is going to be a retracement in the trend. This is specifically what I'm talking about, a retracement, trading the retracement and earning from it, after speaking about the RSI. Now, we can see it's getting close to our support point here. It's getting close to our support point here. We're seeing a resistance point, and throughout the whole time here, we're close to the resistance as well. Now we can see that the RSI is very clearly pointing out to us the change in the trend, the retracement, not all of them, but most of them. It's pointed it out to us here, it's pointed it out to us here, and on 3 or 4 occasions here, again, it has pointed it out to us, okay? Now, the RSI is a great way to be able to determine at which points the price of the security has grown or dropped too fast, or it is overbought, oversold, that is going to find support and resistance. This is what a lot of traders use the RSI for. So I just wanted to give you that example, okay? If anybody's got any questions about this, by all means, they're more than welcome at the end of the webinar to send through their questions, and I'll be more than happy to answer them for you. Moving averages. Now, moving averages is another indicator. So RSI is one indicator. A moving average is a completely different indicator that have nothing to do with one another. Now, the indicator, the moving average, just so you know, is sometimes called an MA. MA is an abbreviation of moving average. So just so you know, in the markets and future webinars, etc., when we're referring to an MA, it is a moving average. So what is a moving average? A moving average is simply an average price over an X period of time, okay? Now, it is down to the trader what average it is showing, okay? So if you're putting a 10-day moving average, okay, all the indicator is doing is showing you the average price over the last 10 days. If you are putting a 100-day moving average, again, the only thing the indicator is doing is showing you an average price over the last 100 days, okay? It's very simple. Now, there's two types. There's two types of moving averages that are commonly used. There's more, but 2 are commonly used, and we're going to talk about only 2 today. Now, there is a simple moving average, which we can see here. And just get my laser pointer. Simple moving average, okay? It is sometimes referred to as an SMA, okay? And there's also an exponential moving average, sometimes referred to as an EMA. Now, what is the difference between the two? There is a difference. Now, the simple moving average is simply giving you the average over the period you have selected, and there's nothing else involved. Now, an exponential moving average is still doing the same, but it is paying is giving more importance to more recent days. So, for example, in very, very basic terms, if you've got a 10-day SMA, it's giving you the average over the last 10 days. If you've got a 10-day EMA, it is giving you the average of the last 10 days, but giving more importance to the last 3 to 4 days, okay? Now, a lot of you are most likely going to ask, how is the average going to help me in my trading, okay? Now, I'm going to show you that on the next slide, okay? Now, what I want everybody to be aware of, again, is that indicators are not 100%. The indication will never be 100%. There is something in the market called a false indication, okay? It's when the market is indicating something, okay, which might not come into action, okay? So I'll also show you partly how to deal with false indications as well. Now, this is another graph, okay, another chart, sorry. It is the euro against the USD, okay, two very well-known currencies. You can see here that I'm only using up-to-date charts, okay. We can see here, we can see towards the end of May, we can see June, and we can see July. We've got our RSI here. Now, the two lines that we can see, hopefully everyone can see a yellow line, and everyone can see the red line also. The lines are a moving average, okay? In this case, I'm using an exponential moving average, an EMA, okay? Now, the yellow line is an average of the last 7 days. The red line is an average of the last 10 days. So we've got a 7-day moving average and a 10-day moving average, okay? Now, a lot of you are going to ask, how is an average going to help me? There is two ways traders tend to most commonly use moving averages. There is a million ways you can use a moving average. There's a million. I'm not going to go through all of them. The two most common ways, okay? And moving average can be used to either identify a trend, okay, the strength of the trend, and also to identify a support or resistance point. On this graph, let's look at something called a crossover, okay, and it is pointing out to traders exactly when a trend is forming. Now the trend, okay, we can see about 4 trends here approximately, and some smaller retracements, let's say. Now the first one we can see is here. What do we notice about two moving averages at this point? We can very clearly see here that there is a crossover. Now at the crossover, we notice a new trend. Okay, now at this point here was a very good indication. Now, when the 7-day moving average, the yellow, crosses above the red day moving, sorry, the 10-day moving average, okay, we can very clearly see there is a massive trend. Now I can tell you this trend here was over 150 pips. So it is a massive trend. There was a massive movement. Anybody that was placing a long-term buy would have come out of the trend very profitable. Now, this is what is called the crossover. Now, we see some other crossovers here, which were not very good indications. This is what I'm referring to as a false indication. We can see here it crossed, but the trend, it wasn't necessarily a false indication, but the trend did not last very long. So depending where you would be putting your stop loss on your take profit would depend exactly whether the indication worked for you or did not. Okay, so this is what I was referring to here as false indications. Now the next crossover is here. Okay, it worked perfectly. We saw a long-term indication and a long-term movement. It crossed again here. Again, a great movement. It crossed again here. We saw a great movement again, and again another crossover. So we can see here in the last about 6 indications, 5 of the 6 were very accurate. They gave a good indication of how the market was going to move next, okay? But we have to bear in mind that there is false indications. The strategy, this is a 2x2 strategy, is called, it's using 2 moving averages, sometimes referred to as a crossover strategy, okay? It's not going to be 100%, but it does give you a good indication of when a trend is forming and if the trend is strong enough for you to enter the market for that trade. Now, what a lot of traders do is in order to possibly lower the risk, okay, what they do is that they use more than one indicator. So we can see here we've used a moving average, but we have also used an RSI, okay? So we got the indicator here, as before, is very close to our support line. So some traders will see it as a good point to enter the market. Again, we have indications here. The RSI was quite accurate, the moving average not so accurate. So whether you would be entering or not is questionable. But at this crossover here, we can see it was very high. So a good indication to enter the trade. This point here and this point, okay, it was very, very low in the trend. So another good entry point. We had another crossover here. We had another crossover here. And it's hitting the support line. So you do have an option as a trader to also use more than one indication. Okay, some people may possibly say that it is decreasing the risk of a false indication coming into play. So you do have an option of using more than one indicator. Now, an RSI can also be used, as I said before, as a moving, the moving average can be used as a support or resistance line. This is another chart, okay? Now, using, in this case, the British pound against the Japanese yen. I've got it on a 1 hour chart this time. I want to try and illustrate to you that these can be used on different charts, and they can be used on different currencies, not just one. Now, what do we notice about this chart? We can very, very clearly see that there is an RSI, that there's a moving average in the middle of the chart and an RSI at the bottom, okay? Now, what do we notice when the price of the currency, okay, is hitting the line? When it is hitting the moving average, what is happening? It is finding resistance, okay? So we can see at this point, this point, continuously here, it is finding resistance, okay? This is how you can use the moving average in order to pinpoint support and resistance line. Also, you can use it as, in a sense, a cloud, whether it is, when it's crossing the cloud, it's indicating a new trend. So possibly here, it crossing the moving average could be an indication that the trend will continue in this direction, okay? But I want to illustrate to you that it is, in a sense, a barrier, okay? As we said before, a support and resistance point is where the price is finding it difficult to cross, okay? So you can also use it for this in your trading. And again, we can see here the RSI was quite accurate as well. It hit the resistance, it hit the support line, and it very, very clearly made an upward movement. It hit again here, and again, very, very clearly found support. Okay, so we can also see here that I'm using a mixture of one or two indicators. Again, a lot of traders state that it is a way of spreading the risk. Okay, trading the range. Now, we saw this chart earlier on, okay? Now, the range, very simply, is when the currency or the stock is trading in between 2 points, okay? It is a trading strategy that has been around for many, many years, okay? The strategy, as I said, is earning and placing the trade when the security is moving in between 2 points. As we can see on this chart here, it is moving only in between the red lines. So when it is hitting the bottom of the line, okay, it will be finding support and moving upwards. And when it's moving to the top of the line, it was finding resistance. That is the basics of trading the range. I'll go on a little bit more in-depth detail in other webinars with regards to how to trade it, okay? But this is one of the most commonly used strategies out there in the market. It is trading the range, okay? Every currency will have a range, okay, or other securities, okay? Sometimes the ranges are short-lived, so it might be in this range, and let's say at this point come up and create a new range, okay? Nonetheless, there will always be a range in which currencies are trading in, whether it is a short-term range or long-term range. Now, definitely do some research and talk to the account managers and myself with regards to how you can personally yourself be trading the range. This is what range trading is, okay? Indicators are not 100%. I stated that earlier on, okay? So you must have a risk management plan. You must have a trading plan that you know on a day-to-day basis how to trade the market. This is something that we're going to be covering together. It's something you can speak about with your account managers also. Buying the dip. Now, most traders out there in the market are looking for a way to buy the dip. It's what most people are looking for, okay? Now, buying the dip has been around for a very long time. It has been around from the very beginning of the stock market, but I want to tell people a little bit about it and the risks involved. Buying the dip is great. It has worked for very many people, but there is a massive risk involved in buying the dip that I want people to be aware of. Buying the dip is when a currency is falling in value and you yourself believe how much longer can it fall, or it surely possibly cannot fall any further. And you open a buy position, okay, in order to try and earn a profit from the price correction or possibly the retracements in the market. Now, what I want traders to be aware of is this. There is a reason why that security, okay, whether it's currency, stocks, or commodity, is dropping in value. There's a reason why it's dropping in value. So before anybody is entering a trade, please make sure that they're doing their research in order to ensure that they are they're placing a trade which they believe is at the end of the trade is going to be in profit. Okay, so I wanted everyone to be aware about the risk in buying the dip or bottom fishing, sometimes it's normally known, or trying to catch a falling knife. Again, it is quite commonly known as that also. Now, I want to look at a little bit at our website, our platform, and also a little bit at the MT4, okay? So if you bear with me, I will get my MT4 up for everybody. Let's look at the platform first. So this is our platform. This is Stratton Markets platform where everybody has registered for. Okay, I just want to go through it a little bit to give you a basic understanding on how the platform works. Now, you can see you have a variety of different instruments and securities which you can be trading. Okay, so we can see it's Forex, so currencies, cryptocurrencies, commodities, stocks, and indices. Now, if you're not 100% aware of what they are, speak to your account managers or myself, and I can go in a bit more detail with regards to how they work. Now, we can see here a buy and sell, a value in lot, okay, the pip value and required margin. What do these things mean? okay? The value in lot is basically the size of the contract. One lot value is $100,000, okay? So you need to adjust the lot value, okay, with regards to what it is you're looking to be trading, okay? Now, the required margin is what is more important. So what you can see here, okay? To open this contract size, this is required as an investment, okay? Now, if you were to change it, let's say put 2, this will change. If you were, let's say, going to open a very small trade, like so, it would trade again. It would change again. So this is the required margin, okay? You can, if you believe the currency is going to move down, you'll be opening a sell, which basically means that you believe the security will drop in value. If you believe it's going to increase in value, you'll be clicking a buy. Now, when you click a buy and sell, you've got an option of the take profit and stop loss. A stop loss is an amount you're not looking to lose anything more than that. Okay, so it's a point in the market you're looking to exit. And a take profit is the same also, but for profit. It is a profit in the market which you're looking to come out of. Now, you've got an option of placing both, and then you're simply clicking invest. Once you click invest, you have officially entered the market. Now, I want to also show you the MT4. This is what the MT4 looks like for anybody who has not used it before. It looks a little bit scary, but believe me, it is not. Now, buying the dip, I wanted to give you an example of what a lot of people might do in buying the dip. This point here, okay, this red line, it is very low. The currency there is very low. We can see here in recent times, it has been much higher. People might say it's not going to drop anymore, but it does. They might say the same here. They might say the same here. And as you can see, it keeps on dropping. What I want people to be aware of is that the currencies can continue to drop. Now, what I want you also to be aware, just to let everybody know, anybody looking to input into their trading an RSI, which we spoke about today, this is how they do so. Relative Strength Index, you can see it on the screen. Or if they're looking to do a moving average, it is like so. Now, I want to thank everybody who today watched our webinar. It was a pleasure having you here with us. Now, you can see my email address here. Hopefully, everybody by now has an account manager. Any questions which anybody has with regards to technical analysis, what I've spoken about today, or anything with regards to the trading which possibly you might be finding difficulty with, that you have never, which maybe has not been covered in this webinar, please get in contact with either myself or your account manager or anybody here at Stratton, and we'd be more than happy to help you with regards to your issue. Do not forget that next week on Tuesday at the same time, we will have our next webinar. The webinar will cover the next steps that you need to be looking at in order to continue your development as a trader. We'll be looking at risk management, we'll be looking at trading plans and much more. So hopefully I will see you, I'll see everybody next week. Again, thank you for watching today's webinar. Anything that anybody needs in terms of what has been spoken about today, please let us know. I wish everybody a pleasant evening, and hopefully we will see everybody soon. Take care.